It, it has been a long time, hasn't it, Steve?
It's been a while, folks. It's been a while. So good morning. I'm Steve Rosansky, President and CEO of the Newport Beach Chamber of Commerce, and I want to welcome you to our February economic forecast and market update. Many of those of you attending this morning have joined us for past webinars or our in-person forecasts at the Balboa Bay Resort in October. I want to thank all of the chambers that have co-sponsored our webinar this morning and as well as inviting their members to attend. 2022 came and went without a recession, and the indications so far this year are that the economy is still chugging along at a pretty good pace. Will we head into an economic winter later this year, or are we headed for a soft landing? Here at the Chamber, we have our own Punxsutawney Phil, and his name is Professor Christopher Schwarz.
It's Groundhog Day.
It's Groundhog Day. That's what, February, well, 2 weeks ago, right?
Yeah, 2 weeks ago, a little late.
So for those of you who haven't heard Chris speak before, let me read a short bio. Christopher Schwarz is a professor of finance at UC Irvine Paul Merage School of Business, as well as the faculty director for the Center for Investment and Wealth Management. During his time at UCI, he has been published in all the leading academic and practitioner finance journals. His research has also been cited by the New York Times, the LA Times, Wall Street Journal, and the Financial Times, and he has provided a number of economic forecasts in the local community. Chris was recently, maybe not so recently, but was featured on CNBC for groundbreaking research into no-fee trading. Prior to arriving at UCI, Christopher received his Ph.D. from the University of Massachusetts Amherst, during which he also was a visiting doctoral fellow at Yale University's International Center for Finance. He received his BS from Babson College in Wellesley, Mass. And that's a pretty good CV, I think, Chris. So what do you think?
I think you should also mention that we'll do a Q&A at the end. And so if people have questions, they should put them in the Q&A section, and we'll pick some of those out here after we go through the slides.
I can't even remember the instructions here anymore. So yeah, put it in the Q&A and we'll get to that at the end. So Chris, I'm going to stop my video. Why don't you take it away?
All right, Steve. Well, it's good to be back. Honestly, I don't remember the last time we did a virtual one. I know everyone's excited to be back in person, and clearly it's been a lot of fun. And I've done a few forecasts in the community. So just before I get started, I think if you had talked to me a couple of weeks ago, I probably would have been a little bit more dovish on the Fed, probably a little bit more negative on the economy. But I think now I'm a bit worried that that financial markets are going to really push the Fed a little bit farther than people are thinking. And so you'll see some of that as we go through the slide deck. So if you saw me in October, or you were one of the private groups that saw me recently, I think things are a little bit more negative. So I don't know about you, but last February, man, it really feels like it was a long time ago, and I was a young man. I think Steve had hair last February. And so, you'd run the numbers, I go through these numbers, and a lot of you have attended my forecast, and you realize that basically when it comes to financial markets, the time was really up, right? We had a lot of retail traders come in and push up tech stocks quite a bit. And so I kind of emphasized this in a lot of my forecasts last year, and I tried to warn people, but often those people would tell me, if you don't mind, I'd like to stop listening to you. And many people probably did. And I've probably been muted by a few people on LinkedIn, which is fine. And then, of course, those same people, which are their friends, I'm going to go on Reddit and they'd say something like, oh, don't worry, everybody, nothing to see here. The party's still going on. And of course, 10 months later, they realize that that's all, folks, that the game is over, that a lot of these speculative stocks are not coming back. And a lot of the things in the economy that were really booming are not coming back. And now everybody's saying, it's bad out there, right? It's really bad. It's kind of sort of like eating garbage, eating a hot circle of garbage. I mean, that's pretty much what we have going on in the economy, right? So my general thoughts are, I think this year the economy is going to slow from the Q4 pace, which was almost 3%. But honestly, I think it's going to be hard to imagine that we have a recession that's going to happen in Q1 or Q2, or start in Q1 or Q2. I think it's going to be later than that, maybe Q3, maybe even Q4. And maybe even later. And I just think the economy has a lot of momentum right now that people are discounting. And I will say that I'll talk a little bit about, my guess is the severity of the recession is going to be very industry dependent. And I'll talk more about that as we go along. I think the Fed's probably going to start to put the brakes on soon. They already have, right? They did a 1/4 point last meeting. I think people are waiting for them not to do any points. But really, I think that, it's going to be later than people think. And I think the market's starting to realize that over the last couple of weeks. I mean, the retail sales number this morning was crazy good. And so it's really going to be a question of how long and how far does the Fed have to go to get the labor market to crack? I think extreme inflation has probably already gone, those 9% prints that we had. The problem is that the easy work is over, right? So getting us to from 9% to where we are now is the easy part. And now it's the hard part of how far the Fed wants to push. And then I think financial markets are going to be pretty choppy this year, right? So if you're thinking about kind of the 4 bullet points, I'd want you to take away from the webinar here is, I think I'm a little bit more actually bullish on the economy than most people, which I know surprises many of my viewers out there who think I'm Mr. Negative. And I think financial markets, you have to be really careful about kind of the rallies that you've seen in January, et cetera. So let's go to the Fed's forecast. All right. So of course, if you've seen me do this before, I always start with what's going on with the Fed. They got the most Ph.D. economists, and they got data that nobody else has. And you can see that their current forecast for GDP is only 0.5% for the year. And note, this is the lowest GDP forecasts essentially since 2009, right? So in 2009, we already were in a recession. And so the Fed said we'd have a recession. It wasn't like they had to forecast that because we were already in one. And you can see that this is the lowest growth that they forecast. And the other thing to note here is the Fed tends to be a little bit biased positive, right? So on average over these years, if you look at the 24 years I have here, they tend to be biased by about 0.7%, right? So right now they're thinking that GDP for next year will be pretty much zero. And the reason that we're going to have GDP near zero is the first thing is just we're out of people still. I mean, we're still out of people. I mean, the unemployment rate is 3.5%, right? And if you look over time, this is pretty much the lowest it's been, right? So, tech bubble here was about the same, right before COVID was about the same. And if you go back to the 1960s, I think that's probably the time when you have unemployment that's closer to the numbers that we've had today, right? So in terms of people in the economy looking for a job, everybody's got a job that's looking for one. If you look at the number of workers, everybody's back to work. So I know a lot of people have talked about, well, you have, all these jobs are still missing from the economy. That's definitely not true. We have 1 million more people working now than we did pre-COVID. And so certainly it's not a situation where we don't have job growth going on. We have lots of job growth going on. And if you look at the participation rate and the percent employed in terms of people that are working age, so this is the ages 18 to 65, again, you can see we're pretty much close to the peak and we're above where we were pre-COVID. Right. So the only times really that participation and employment have been higher is really kind of back in the millennial time here. And there's lots of reasons that working age people from, if you think about 18 to 22, one of the reasons this is down is because more people are going to college. If you look at, 22 to 25, a lot of those people are getting graduate degrees, so that's great. But it pushes down these participation and unemployment rates a little bit from where it was back at the turn of the century, or millennial, or whatever makes you feel good. All right, so one thing to note here is, and one thing that drives me crazy as an economist and a statistician is the Bureau of Labor Statistics, otherwise known as the BLS. In this case, you can take the L out and just call them the labor of BS, the Bureau of BS. So what they do here is they have the actual versus reported participation rate. All right, so the orange line is what BLS puts out for their participation rate of people in the economy. Right. And so if you look at the orange line, you can see the orange line is pretty far down from where it was before. Right. So, the orange line, the axis is over here. So if you cross here, you can see that participation is close to 62%. And that's a lot lower than it was at the millennium when it was 67%. But if you look at the blue line, so the blue line is actually the participation rate in terms of the percentage of people that are of working age population. You can see here that it's almost kind of near the high, right? So again, you have this section that's a little bit higher, which we talked about previously, but you can see it's not showing this lack of participation in the economy. And the issue is that when the Bureau of Labor Statistics computes the participation rates, they look at anyone that's 18 years and older, right? So everyone like 90 years old that's alive is included in the denominator for the orange line. And what the only population that's increasing in size in the US is people over the age of 65. In fact, there's an article I saw this morning that now 1 out of every 6 people in the US is over the age of 65, right? So I just want to point this out because again, there's this kind of, I think, this falsehood going around that, people aren't going back to work and we have all these workers and why are they not going back to work? And that's simply a function of a bad denominator when it comes to participation rate. So I want to point that out as you hear these labor reports come through the next few months. All right. So don't pay too much attention to the prescribed participation rate. So the last point on labor is really there's no one coming online soon. Again, if you see me do these, I'll always point this out, how a working age population is pretty much plateaued. At some point soon, it will be going down. It's already going down in China. Of course, we know it's going down in Japan. It's pretty much an industrial country problem. All right. And the only thing preventing this from going down is things like immigration. We're just not having as many children here in the US and a lot of industrial countries, which is eventually going to make our working age population go down. All right. And so this is a problem. Again, if you think about yourself as a company, if you're a company and you can't hire anyone, how fast can you grow? And the answer is certainly not very quickly. And so that's why I think this year we're not going to have a lot of growth. We just don't have any slack in the economy to really get growth going, right? We're kind of sort of where we were right before COVID hit, where everybody's employed and nobody can hire anybody. All right. The second problem that we have for our economy is because of the person that Michael Scott's looking at here, who's the thief of joy. And the thief of joy is going to be Jay Powell. All right. So Jay Powell wants to cause us some pain. All right. The only thing painful on this particular screen is this person's glasses. I have no idea what's going on here. I presume they're kind of on some Instagram filter or something. But regardless, Jay Powell wants to cause pain. All right. He is the Mr. T of the Fed number 3, right? So Rocky 3 was Mr. T. And he wants to cause some pain. And his name is not really Jay Powell. I did not know if you know this, but he wants you to call him Neo, right? Because no one has ever moved as fast as Jay Powell is right now when it comes to interest rates. All right. If you look at the speed at which the Fed is increasing interest rates here in the US, you can see here, these are different periods where the Fed cycle has been tightening. You can see I have all the way back to 1972 here. There's a couple in the 1960s that are slower than what I have here. I just don't want to have too many spaghetti lines on the graph. But you can see here in 2022, we have never tightened as quickly as we are tightening with the Fed, right? And it's important to note that it takes a long time for Fed policy to impact the economy, right? So a lot of these rate increases, from here to here, basically, they really haven't fully impacted the economy yet, right? So, it takes about 12 to 18 months for Fed policy to impact the economy. And these rate increases are far sooner than 12 months ago. The reason it takes time is imagine, you have a builder that's working on a new commercial real estate project, right? They're not going to just stop the project as soon as the Fed raises rates. Is when they want to go start the next project. When this one's done, they go to start the next one. That's the one they don't do, right? Because financing is too expensive. And so when you see here, in a few months from now, we're supposed to be at the orange dots. And I will tell you in a little bit here, this orange dot seems to be rising a little bit. So this orange dot might be the next UFO that the US military has to shoot out of the sky, probably. But we're going to see probably interest rates at a level that are higher where I indicate where this red dot is. So the Fed's moving really fast. And one of the difficult things then is to think about how is that policy ultimately going to impact the economy, because it does take some time to hit. So why is this important? So this is what's known as the yield curve. All right. So 10-year long-term interest rates, this is a 10-year treasury, minus the 2-year interest rate, this is the short-term treasury. All right. And so when this thing is positive, right, long rates are higher than short rates, that's a normal economy, right? Expectations are that the economy is going to grow, all right, that the Fed's eventually going to raise rates. And so we should be bullish on the economy. When it's negative, that means that short-term rates are higher than the long-term rates, which means that the Fed policy is really restrictive right now. There's some prediction that we're probably going to have slower growth going forward, and the Fed's going to have to cut rates. I think that's the easiest way to explain it. The reason I have the yield curve here is because the yield curve is the best predictor of recessions that you could possibly ask for. In statistics, it's almost a perfect predictor, right? A perfect predictor in the sense that if there's an inversion, we have a recession, and we don't have a recession with an inversion. Right? There's no type 1 or type 2 errors when it comes to yield curve. So just to show you this, all right, so we got inversion, and then the gray bars here are NBER, declared recessions, recession, inversion, recession, inversion, Vietnam, inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion. You guys are getting the picture, right? It's recession, inversion, recession, inversion, recession. And now we have one of the biggest inversions that keeps getting worse. It's almost -1% right now, which is what it was all the way back in the Volcker days. And you know how bad Volcker hurt the economy. And so, of course, everybody knows what's coming next. That's right, Ukraine. That's what's coming. No, I mean, recession's coming next. So, of course, if there's another war, we might not have a recession, but short of having a big war, it's pretty obvious that we're going to have a recession. Now, please note the distance between when the inversion happens and the recession, it varies, right? So if you look at, say, back, we had our first inversion here in 2005, but we didn't have a recession until almost 2008, right? So it can take some time. Like I said, Fed policy takes some time to hit. But inevitably here, it's clear we're going to have a recession in a pretty short term, all right? And that's why people keep saying, hey, we're going to have a recession in 2023 is because of this inverted yield curve, all right? So let's take a look here quickly and see whether or not we think Fed policy is biting. And so, I would tell you the month of January retail sales that just came out this morning were really, really good. So I don't want to discount those. And I think ultimately that's going to cause the Fed to act even stronger. But certainly if you look at overall consumer spending has started to come down. So this is retail sales, the year-over-year change in retail sales here in the US. Of course, you can see the big dip here, which is the financial crisis. You can see another big dip here, which is when COVID hit. And then you can see this huge spike in retail sales. And so if you're wondering where your inflation came from, it's really a demand phenomenon. I know people talking about supply chain issues. No. People had a lot of money and they went out and they bought a lot of stuff. All right. And so really the inflation aspect, it came from demand. And you can see that here with retail sales very clearly. And you can see now it started to taper off, right? It started to come down to somewhat normal levels. Again, this month's number was a really good number. If you look at the short term here, so this is the month over month change in retail sales all the way going back to June 2020. So you can see the rebound here from COVID. You can see all the stimmy money that was passed out. And now you can see that essentially retail sales have been going down. Of course, now we're back up here. And so the trend's kind of over. And so that's an important data point to think about. Is January the anomaly, right? Is there something in there in the January data that makes us, buck this trend permanently? Or is it just an anomaly that we're going to return to this trend? I think that's going to be the real difficulty for the Fed to find out. But overall, I would tell you that Fed policy seems to be hurting retail sales a little bit. If you look at the savings rate, again, if you think about how much money people have to sell, to spend, our savings rate has never been lower, all right? So it's due in the limbo, all right, which means that probably people are starting to get a little short on money, although I heard that there's still $1 trillion left for people to spend from stimmy money. You have the poor crypto bros, right? So of course, crypto has not been doing well. Apparently they really like G-Wagons and McLarens, or also Rolexes. So if you're in the market for any of those three things, you might want to get on your local Craigslist and you can probably get yourself quite a deal as they liquidate this, as their Dogecoin didn't end up as valuable as they thought it might. If you look at housing starts, so housing starts have never declined this much. So you can see we're all the way down to about 1.4 million or 1.3 million housing starts. We were almost at 1.8. You've never had this kind of decline in housing starts without there eventually being a recession, right? So again, another indicator that says we're going to have a recession at some point soon. So again, Fed policy looks like it's affecting housing starts, which makes perfect sense, right? High interest rates, low demand for housing. And the one thing I always look at when I think about how wealthy people are is I always look at tax receipts, right? So no matter how you make your money, all right, and unless you do it kind of the Mexican cartel way, you're pretty much making it and paying tax, right? So if you have a capital gain, or if you have a W-2 or a 1099 or whatever you have, eventually you're going to pay taxes on it. And if you're looking here at our tax receipts year over year, as you can see, they've been negative the last 3 months, which would indicate to me that overall people are making less money to spend the last 3 months than they were before. I get another sign here that things are starting to moderate a little bit when it comes to our economy. But again, nothing is falling off a cliff here, which suggests that maybe we'll have a soft landing, but most likely the Fed's got a lot more work to do. One of the fun parts about this is there is no fiscal stimulus help coming. Of course, the Republicans run the House, the Democrats run the Senate. So the federal government's not getting anything done. And you can see here in California and a lot of states now, of course, people didn't extrapolate very well. And you can see here that we're looking at a budget deficit here now this year in California up to $20 billion that we're going to have to deal with. So if you think about kind of the federal government being this kind of tailwind for the economy the last 2 years, well, now that kind of tailwind's over, right? And now it's become a bit of a headwind for our economic growth, as government spending is going to have to come down as tax receipts come down. All right, great. Things are slowing down again a little bit. So this is terrific. The Fed's job looks like it's getting done. There's only one small technical problem, which is, as Lumberg once said, yeah, we kind of have a problem here. And that problem is the labor market. And according to Monster, 96% of people are looking for a new job. Now, I'll make a couple of notes. So one is, I don't know what the baseline here is, right? My guess is that 96% of people are always looking for a new job. Of course, I'm not talking about you, Steve, and I'm not talking about me, and I'm not talking about anybody else in this webinar if their boss is listening. But people are usually kind of job hunting. The other thing I'll notice, 82%, I don't know if 82% of statistics are just made up. So there's a good chance that this number is really not a true number. But I was commenting to Steve before it came online. I go on my LinkedIn, and like every post is like, I took a new position at some company. I took a new position at some company. And you can see that there is just a very, very strong labor market out there. And if you look at jobless claims, which are kind of your real-time indicator on how the market's doing, jobless claims and continuing claims. So these are people who are continuing to take unemployment after they filed the first time. You can see these things are basically at series low, right? So there is no weakness in the labor market at this point, right? So people point me out probably later to the Meta layoffs or the Google layoffs or whatever. And so, yeah, that's great. They've laid off 60, 70,000 people. And of course, I'm empathetic to those people, but we have 160 million people employed here in the US, and 70,000 isn't very much, right? And so we just basically have a situation where we have no people. Everybody's got a job. Everybody's got pricing power. Everybody's going out and get raises, and everybody's going to spend that money. And guess what? That's causing the inflation, and that's what's causing the Fed to be very restrictive on monetary policy, which I think is something we'll see most of the rest of the year. Right? So I know things seem bad, right? So I'm nothing but bad news so far, actually, except for the fact I think I'm more bullish on the economy than most people. But you can't just always think so negative, right? You got to start thinking about something positive. And if I do have any kind of positive gauge about the economy, it's that essentially, I think we plateaued when it comes to what our inflation looks like. All right. So again, I know probably a lot of you have seen this graph before from me, but let me go through and explain it to you. So on the left-hand side here, I have the headline CPI number, right? So our headline CPI number last month was 6.4%, for example. So that's what you have here in the powder blue bar. All right. And so what happened was when COVID hit, and some of you might remember this, in March of 2020, you could get a barrel of oil and $32. Literally, someone would pay you $32 to take a barrel of oil. The price is negative $32. And so, we had a lot of inflation here. All right. But really, I thought most of that inflation was, if I'm going to be honest, it probably was transitory, right? So if oil goes back to $60 a barrel the next year, that's oil prices are not high. They just kind of went back to where they were. All right. And so what I did was I started to estimate, what part of these bars on the left, what part of these are from oil prices coming back and from used car prices being really expensive. And that's what's in the middle here, right? That's the portion of these bars on the left that came from here. All right. And by the way, used car prices were high. If you're just wondering why they were so high, of course, think of all the people like in New York City, for example, that take public transportation that weren't really willing to go on public transportation anymore, right? They had to buy a car, right? So you had this one-time bump in demand as people needed cars. And so if you take the left and the middle and subtract it, you end up at the right. All right. And the right is kind of what I was thinking about as core CPI. And again, if you think about the beginning when the Fed was using the T word, you can see that, kind of inflation here was really under 2% or close to 2%. But the problem is that for the Fed, that inflation kept rising until essentially at 6% inflation kind of at its core. And you can see we've kind of plateaued there. So I'm not sure that we're going to make a big push above where we are now. The question is, how long does this take this to come down, right? Because 6% sounds great from 9%, but 6% is also way higher than the Fed's expectations or Fed wants at 2%. How far does the Fed have to go to make inflation come down? How far does the Fed have to go to ruin the labor market, basically, to cause that pain that Jay Powell's talking about? All right. The thing that's causing a lot of inflation now is shelter. Right. So there's a shelter component of CPI. It's about 1/3 of CPI is shelter. You can think about this as where you live. And you can see here that I have year-over-year changes in rents based on Zillow and apartmentlist.com. And you can see, again, we had this huge year-over-year change, 18% year-over-year change in the price of apartments as people realized they couldn't stand their roommate. and they had to get another place to live, right? So you had this artificial household formation as people didn't want to live with somebody that they had spent 24/7 with for months on end. And then you can see here the gray line is what CPI shelter is year over year. And you can see here now we're kind of over where the data is showing us, right? So we're under here and we're over here because it kind of lags a little bit. It takes some time to catch up. And if you really think about it, shelter is the biggest component that we have here. So shelter is about 8%. I'm going to make the math easy for myself. And then 1/3 of 8% is 2.67%. So if you think about that 6.4 number of CPI that I talked about, 2.7, almost half of it, or we'll call it, 40% of that is just from shelter, right? So shelter is a really big number right now when it comes to CPI, and housing is coming down too. So if we think about it, that shelter number that's a little bit lagging, so really probably CPI is a bit lower than where we are now. But even if I were to take out transportation, used cars, and shelter, this is what CPI would look like, right? Where you can see we plateaued back in May at like 3.2%, and we basically stayed there for the last 8 months, right? So we have gone nowhere in terms of 9 months of reducing CPI beyond this 3.2%. And this is the really sticky part I think the Fed's gonna have a lot of trouble getting rid of without a good quality recession. And so I think the Fed's gonna have to push a lot farther than they think, because ultimately if inflation is 5% or 6%, Fed funds rate has to go way above 5 or 6% to actually cause real rates to go positive and for people to stop spending money. And just to show you or illustrate where we are now, a year ago, if this was February 2022, the blue line is where expectations were for rates. If you look at September, you can see the green line was where we expected rates. And so I want to pay attention to the green line. So the expectation was in September, essentially the Fed was kind of at terminal. They call this the terminal rate. In January, which was they weren't going to raise rates anymore, and it's going to stay there for like 2 years, right? So you can think about this as, the economy is not overheating, the economy is, not going into recession. We're just going to keep things the same. So I'm going to call that like the Goldilocks economy. If you look at January, so just a few months ago, you can see that, well, in January, we were expected to get up a little under 5%, like about 4.9% for our peak. And then the Fed was probably going to start cutting rates at the end of this year, implying that we were going to have a recession by Q4. And now if you look at it, you can see the peak's gone up even higher, almost 5.25 now near the end of the year. And you can see here the Fed's not going to really start cutting rates into 2024. So you can see two things. Number one, the peak of rates is expected to be higher, and the recession's kind of got pushed out a quarter, which I think makes a lot of sense. I wouldn't be surprised if you see this peak hump here even go higher and start peaking up to 5.5 or maybe even 5.75% if we can continue to see the kind of data we've seen on jobs and consumer spending the last couple months. All right, last point on the economy, and I'm going to talk a little bit about financial markets. Who's the recession going to hit harder? So I was very honored. I gave the senior leadership at Edwards their econ and financial forecast about a month ago. And so Edwards is based here in Irvine, so I put them there, and Rivian is based here in Irvine, and Rivian's got great cars, and this is nothing against Rivian. But if you think about which one of these two companies is going to hit harder, it's going to be Rivian, right? And then it's not just because Edwards is in healthcare, it's because of how a recession happens, right? So ultimately a recession happens because people become too excited about the investment prospects in a particular space, right? So if you think about, back in 1999, people were way too excited about tech. I mean, we gave money to everything, including pets.com. Obviously, those things were not worth all that much. They went bankrupt, a lot of them. Even Amazon went down 97% in a year, right? So, the recession hit tech much harder than it hit toothpaste, right? Or it hit even housing. Housing didn't even have a recession in 2000 because rates came down so much, right? Unless you were living in Silicon Valley. In 2008, 2009, what got hit the hardest? Housing, right? Because we overinvested and built all these houses because people were super excited about housing, right? And if you think about the last 2 years with COVID, really the problem was everyone got excited about, and for lack of a better term, the metaverse, right? So webcams and computers and computer chips and social media and all these things. People had this idea that we were never going to go back to the way things were, right? And even Mark Zuckerberg admits that he thought that was true, and then of course it ended up being incredibly untrue. And if you saw my original webinar back when COVID hit in March 2020, I actually made a joke that everything is going to go back to normal, because the number one thing that people hate is change, right? If you go to Amazon and put change management in the book section, there's like 57,000 books on change management. And I think, well, for the most part, we've had gone back to the way things are. The only thing that we haven't gone back to is the one thing we hated to start with, which was our job, right? Nobody wants to go into work. And so really all of our overinvestment you can see is in the tech industry, right? Things that were related to stay at home, right? Peloton, for example, is not really tech. I guess maybe some of you would think it would tech, but Peloton is another place, right? So all these things that we craved and were out of stock and people were willing to pay overpriced for in 2020, those industries are the ones that are going to get hardest. And you can clearly see that's true here when it comes to Rivian and Edwards. So I think this recession is going to be, it's going to be very severe in some places like tech, and then probably not so severe in other places where we didn't have a lot of overinvestment, right? So economic summary here, I'm worried about the economy next year just because I think growth is going to be really low. I think there's downside risk that we'll have a recession, but again, I got this feeling it's going to be a little bit later in the year or maybe even the next year, just because we have so much economic strength right now. There's no way a recession starting in Q1, right? So minimum we're starting in Q2. The Fed must soften the labor market if ultimately they want to get that back down below 2%. And as really the question that you have to ask yourself is, how aggressive is the Fed going to be if inflation peaks at 4%? Right? How hard is the Fed going to knock the economy to get inflation back down to 2% if it's 4%, which is not terribly high? And I don't know the answer to that. I think long term, our growth prospects here are pretty low. In the US, we just don't have any people left. And so ultimately, I think our long-term GDP expectation should be, maybe between 1 and 1.5% is probably going to be average the next decade. All right. So don't forget financial section here, probably 5 or 10 minutes, then we'll open it up for questions until 11. So there's lots of opportunities in the markets, right? So if you look out there, I'm like, oh my gosh, there's so many opportunities. Unfortunately, they're sold by these two guys, the stepbrothers, right? I do find it interesting that John C. Leary here looks a little bit like SPF. Does anybody notice, the similarity there? And so, of course, SPF ran FTX, which is in bankruptcy right now. Of course, if you have a crypto account right now and you try to redeem your money, or lots of people try to redeem your money, it's a joke. Because pretty much the crypto exchange is going to respond, well, perfectly well, we don't have your crypto in cash to redeem your money, right? So if enough people go in, they'll just have to close the exchange, and that'll be the end of that. And if I had one piece of financial advice just to sum it up for you, just don't do what these two people do. I know that ARK is up like 40% this year or something like that. And I know Jim Cramer, he's a force of nature. Nobody knows how he hasn't had a heart attack or an aneurysm on the air yet because he turned so red. But they're not good investors. There's just momentum traders. They do not have any skill, right? They don't have any skill. In fact, there's a Twitter account, if you happen to still use Twitter, called the Inverse Jim Cramer account. And it's hilarious. It actually shows you all the times that Jim makes a prediction and then it's just the opposite happens in the extreme circumstance, right? So think for yourself. Don't do necessarily what these two people do. And my overarching theme about stocks, which I told you before, which is, I don't think stocks are going anywhere. Probably really in either direction. I think there's more downside risk to upside risk, which might surprise you because, January was pretty good. But just to comment on January, the stocks that went up are the ones that got destroyed last year, right? So like I said, Kathy Wood's ARK fund was, I think, up 40% in January. The Dow was up 2%, right? So unless you sit there and you say to yourself, you know what, I think we're going back to 2020 and 2021, it's just a dead cat bounce that we had from all of the selling. Like a lot of people maybe did tax selling and they wanted to buy it back in January. But the bottom line is, this is the way I think about it, right? If the economy's doing really well, right? Let's say that there's no recession, right? The Fed's going to have to tighten, right? The Fed's going to have to tighten, right? So earnings will be good, but rates will have to go up, right? So earnings up is good, rates up is bad, and so stocks will be flat. If the Fed's loosening, that means the economy is going into recession. That means earnings are bad, right? Which of course, earnings down brings stocks down, rates down brings stocks up. And so the end of a flat is just a trade-off between what's just better, earnings or interest rates. And so my guess is ultimately we'll have a bouncy year where we end up maybe plus or minus 5%, right? I don't see a huge bias. If you made me guess, I would say we'd be down a little bit this year, which really puts me kind of out there on a limb because, the market's up, right? With only, 10 months to go. So I'm making things kind of difficult on myself, but that's kind of the way I feel about the markets. Like you can see today, consumer spending, good news, right? Great consumer spending. Fed's probably going to raise rates, right? And that's kind of the issue. So one of my favorite charts to look at to get kind of an idea of whether or not things are bubblicious out there is to look at the NASDAQ versus NYSE chart, right? So this is the value of the NASDAQ divided by the value of the NYSE. And again, the reason I look at this is in most periods, you can see it's either flat or it's slowly maybe going down as our economy becomes more tech oriented. And then you have this huge spike, which clearly sticks out from the rest of the graph, which meant tech was way overvalued. And if you go here, I pointed this out before, tech is way overvalued when COVID hit. And now you can see it's basically mean reverted almost back down to where it was before. The real question you have to ask yourself is the pre-COVID level, the rate level for tech, or is it down where it was before? And that one I can't answer. I don't know the answer to, but I will say, I think the easy money in betting against tech versus other stocks, that's probably over. All right, so we can probably skip that. The other point I want to emphasize is down a lot does not equal cheap. I think there's this confusion with, hey, something's down, 50%, that must mean it's cheap. If we look at the price to earnings ratio here for the market, you can see that it's lower, but you can see there's not many time periods in the past where we paid more than we do for stocks now. One of the biggest ones, of course, is the tech bubble when you didn't want to buy stocks. If you look at the relation between PE and rates, so some people tell me, well, Chris, rates are so low, that's why price to earnings ratio is high. So let's take out this red circle here, which is the internet bubble. You're basically here, right? So you're kind of at the top of the range where PEs would be given the interest rate we're at. So again, it doesn't like stocks are cheap even after adjusting for interest rates. And if we look at price to sales, these are price to sales ratios. Snowflake trading at almost 25 price to sales, right? That means if you buy $1 of Snowflake, if it doesn't grow, it'll take you 25 years just to get your dollar of sales back, or $8 sale. That's crazy. NVIDIA is trading at 15 times sales, which is just, again, a crazy thing about the crypto market exploding. You can see price to sales have been coming down from where they were before, but still you have some companies out here that have some pretty incredible price to sales ratios. My guess is they're probably overpriced. One of the things I like to tell people, just because something's gone down 95% doesn't mean it can't go down another 95%, and that's Dogecoin. This chart is actually a little bit old, right? It's been spiking around because Elon keeps talking about it. But basically Dogecoin's down 90%. It needs another 98% to get down to where it was pre-COVID. So just because something's down a lot doesn't mean it can't go down a lot again, because it's all in percentage terms. All right, last couple of things here, and then we'll get ready for some Q&A. I think your big opportunity this year is going to be with long-term rates, and I'll explain why in here. You can see that historically they're very low, but in the short term they're actually a lot higher than they used to be. Right. And if you weren't here before, I kind of did this analysis where, probably the biggest explanation about why rates are coming down is just because our population is getting older, right? The more and more money that people have out to lend, the less interest rate they can charge. And so, as I mentioned, now 1 out of 6 people is over the age of 65. That's a lot of capital that's looking to earn return. And of course, that return is going to be low, which ends up with low interest rates. All right. And you can see here that over the last couple of years, you can see that, well, pre-COVID, we had a rate of 3.2, right? You can see this started going down in 2019 as we started to worry about a recession. In fact, pre-COVID, our 10-year treasury rate was only about 1.7%. And you can see that spiked a lot over COVID, and now we're closer to 4% than we were before. All right. And the reason I like the long-term rates is because, one, there's no earnings risk. I don't have to worry about earnings. But 2, I feel like long-term rates are kind of a win-win, which is, if the economy does really well, the Fed's going to have to tighten a lot. They're probably going to have to overshoot, which means they have to cut a lot later, which means the same or lower rates. And if the economy does really bad, then the Fed's going to cut rates, and of course, the long-term rates are going to go down. So either way, I kind of win or I push, and in the meantime, I earn a 4% yield. So I can't really argue with that. All right. By the way, earnings estimates are going down. So if you think about stocks, we're rallying right now with rates going back up and with earnings estimates coming down. So if you look at the expectation for earnings back in September, expectations were going to grow at 8%. Expectations were only going to grow at 2.5% now, right? So earnings expectations are coming down. Rates are going up. That is not a good recipe for stock returns for the rest of the year. Right. So putting it all together, again, I don't think markets are going anywhere. So make sure you don't get that fear and that FOMO that can drive your trading. Have a strategy and stick to it. Avoid the crazy pockets of craziness that still exist. I think there's still a long-term opportunity in bonds, like a TLT or a TLH or something like that. Again, talk to your financial advisor before you do anything. And I think that the markets have a lot more work to do in terms of the earnings front of price in a recession. I think then is the time to buy some stocks. All right, last thought here. So I got 2 slides to go, so again, get your questions in so Steve can look it over. I've had a couple of questions about the dollar. The dollar, of course, last year was incredibly strong. There was a point last year where the dollar was past parity, like it was like 96 cents for €1. All right, but you can see the dollar's been shrinking quite a bit lately. Honestly, this is just interest rates, right? So as U.S. interest rates go down, the value of the dollar is going to go down, and you can see that here very clearly. So the 10-year interest rates in orange, the U.S. dollar index is in blue, and you can see here that they've been tracking each other pretty well from 2022 over the course of this year, right? So in conclusion here, I think the Fed's going to be aggressive. We're eventually going to have a recession, but we're going to have to wait a little bit later than people think. I think that's going to be good for long-term rates, but bad for earnings growth. So I think that's why I favor bonds over stocks. And with that, Steve, I think we are ready for some Q&A.
Well, good thing, because we have lots of Q&A here.
Right.
It looks like 25 questions in the queue. If you have any other questions, please add them in and we'll try to get to them. I think we've got about almost 20 minutes to go. So first up is an anonymous attendee, asked at 10:09, discuss the impact of the wave of tech layoffs. I think you did cover that a little bit, but maybe you just want to.
Yeah, I think, again, I think that tech is going to be the hardest hit area when it comes to this particular recession. And I think that's going to be, and that's just simply because that's where the overinvestment is, right? So, everybody in 2020 had to go buy a webcam and a new computer because no one had upgraded their computer in 10 years. And they needed a light so they didn't look like they were deaf and everything else that had to go on. And now nobody has to upgrade their computer for 10 years, but tech companies built out their companies like they're going to have that kind of growth for the next 10 years. And now it's starting to catch up with them. And that's why I think the recession is going to hit them the hardest.
Well, anecdotally, Google laid off, I think, 12,000 employees. And unfortunately, my nephew was one of them. And I thought, wow, that's going to be a bummer. But I talked to him not too long ago. He was actually pretty upbeat about it. They got a great severance package from them, and he's getting offers for more than he was even making at Google. And I think he was, a little surprised and wished he had kind of looked around, been part of that 97% that were looking for job offers from other places. So.
Well, maybe we should make that next Fed raise a 75 bips, Steve. Maybe we should up it to 75 bips.
Jose is asking, will they get a copy of the presentation? This has been recorded. It will be up on our website at newportbeach.com, and we have the emails addresses, so we'll try and send it out to you.
And I'll post the slides sans memes for people if they want to take a look after.
Very good. A few questions here. I think they were taken care of. Jose again says it would be useful to see a chart comparing real interest rates, nominal versus minus inflation, for different periods of time. I suspect that it would explain why the rates had to rise faster compared to other decades. So is that the case? Yeah,
the Fed was much farther behind. So if you look at CPI versus the 1-year rate, the Fed had never been farther behind last year. So you're correct.
Okay. Jason wants to know, why does inflation need to be 2%? Why can't it be 3 or 4%? It's good for my real estate if my property.
So I don't know that necessarily there's the correct. I think in a perfect world. So I'm gonna put on my J Powell hat here for a minute. So in a perfect world, the Fed would want inflation to be 0. Right. So the Fed wants inflation to be 0. The reason that the Fed doesn't target a 0% rate is because they need some leeway, because deflation is horrific for modern economy. Right. So if you get in a deflationary situation, which is what Japan has, then essentially it's a self-spiraling thing, right? Where, hey, if I know that everything's going to go down price in 5 months, I'm not going to buy a car, I'm not going to buy a house, I'll just wait 5 months and everything will get cheaper, right? I can bury my money in the backyard. At the same time, people's incomes go down, but their mortgage does not, right? So then default rates go up because people can't pay the mortgage. And so the Fed keeps inflation a little bit above 0. Because what they want is that when we go into recession, they want to make sure that we don't end up with deflation, right? So they have that 2% inflation as their target. Whether or not that's the perfect target, whether that's 3 or 4, I don't disagree with the person that wrote the question. It's kind of arbitrary, and that's why I made the comment. How hard does Powell want to push? if inflation is 4%, right? Does he really want to annihilate the economy to get us from 4 to 2? And, you know, 4 is, if people know it's going to be 4, it's not that big of a deal, right? I think it's just for such a long time, we've had 2% inflation and so low that people, I think, kind of, I don't know, centered on that particular number.
You know, you always used to hear that the Fed was sensitive to election years and things like that. I mean, this year clearly is not an election year, but next year will be. Do you think that'll play into it at all, coming elections, or that's just too far out to?
I think it's probably too far. I mean, I think the Fed generally has a pro growth bias, right? I think probably Volcker is the only person that really had an anti-growth, no inflation bias. But I think most of the Fed, you know, I think they generally have a growth bias. So I don't know. We could ask George W. Bush about that. Let's see what he has. Any no, George Herschel Walker Bush, the first Bush who got the Fed put us into recession. He lost re-election. He probably has some thoughts on that.
Yeah, unless you have some like tarot cards or something. I don't think we can be talking to George anymore.
Oh, that's true. I forgot he passed. Rest in peace. Sorry.
Yeah. Oops. No worries.
We can edit that out, right, Steve?
Alan, yeah, sure. Alan says layoff is huge, but unemployment is at an all-time low, but high-paying job counts reduced significantly. Would you be worried about it to lead to some crisis? So I guess he's concerned that the jobs that are people where these layoffs are in high-paid jobs, does that change your calculus here?
I don't know. I would argue working at McDonald's these days seems to be a high-paid job. But you know, I don't. So I'm just going to be honest. I don't see any evidence, or I've not seen any evidence that we have more lower-paying jobs now than we did pre-COVID. I would be a little bit surprised if that were true. So I mean, obviously the layoffs that have been public that everybody has seen from Google, et cetera, those are machine learning, programming type jobs. That yes, they are high-paying jobs, but again, that's, you know, 60 or 70 grand out of 160 million. And as you noted, Steve, your nephew is going to get even more money. So
Exactly.
and so that he can double dip, right? So he can get his severance and he can go back to work and make more money. So
Actually, I think that's part of the deal. He can't take another job.
oh, you can't double dip.
Well, he's getting yeah, he's not allowed to double dip. He's got to kind of just sit at home for 2 months and you know, apply for jobs, I guess.
See if he can make even more money. All right,
Exactly.
there you go.
Exactly. Anonymous says, so with unemployment at historic lows, do we have a legitimate disconnect between those still on unemployment and employers? Are workers unable to find jobs which match their skill sets, or is there a subset of workers who do not actually want to return to work?
So again, I don't think anybody wants to go back to work. Well, shouldn't say that. Most people would prefer to continue.
Like work.
You know, I know somebody, like I joke all the time, but it's true, that has one of those random things that randomly move your mouse around from Amazon.
Oh yeah,
and
I saw one that had like a thing that pecks your keyboard like this. Yeah.
Exactly. So I mean, actually, I'm on a golf course now. This is just some virtual background music, but in all seriousness, you know, so unemployment's never been lower, right? So whatever you think of the cause of unemployment, right, it's no worse today than it's ever been in the past, right? And so not to go through the, you know, the economics 101, you know, there's generally 3 types of unemployment, right? So you have, and I'll mention 2 of them. You have the one, which is you have what's called transitory unemployment, which is, so for example, your spouse gets a new job to move from California to Texas, and you're unemployed because you moved from California to Texas. And so you'll be employed soon. It's just you are unemployed for a period of time because of some transitory issue.
Right.
The second type of unemployment that we call it is kind of like the permanent unemployment, which is that mismatch between skills and jobs, right? Where you're unemployed and you want to get a job, but simply there's no job openings that are suited for your skill set. And I'm sure there's some of those that are going on, right? And then I'm sure there's a little portion of it that's like your nephew who, you know, is probably claiming unemployment, who really is not unemployable, right? And they have a bad incentive to remain unemployed. But really, I mean, whatever those factors are, they're better now than they've ever been. And so I think that's one of the, you know, the real key points here when we see unemployment so low.
Okay. Stacy wants to know, do you think that the Fed has created some unintended consequences for shelter, making it worse through their rate increases?
So I think it's actually the opposite, Stacey. You know, I would tell you that the Fed, by keeping rates really low for a really long time, made shelter inflation really high. by making it so cheap to buy a house, right? So, it's really kind of interesting, if when we were doing this 15 months ago, I don't know if you remember, Steve, I told you that real estate was incredibly cheap and people thought I was out of my mind, but it's incredibly cheap because you're not going to remember this, but 15 months ago, mortgage rates were 2.7%. Right. And now, they fast forward a year later and mortgage rates, when we were talking in October and going into December, et cetera, rates were like 7-something%. Right. And so
I don't know if the real estate was cheap, but the payment was cheap. That's
well,
for sure.
but that's the part that matters, right? So, if you watch House Hunters, they don't go off the price, they go off, well, this is what we can afford per month, right?
Yeah.
And so now, if you go to we went from incredibly cheap to incredibly expensive in an incredibly short amount of time, which is getting to the Fed rate increases.
Yeah.
And so now you see that affecting real estate, where month over month changes in real estate prices are negative, right? And that's eventually going to catch up with shelter. And you have all these apartments, again, speaking of a place that a year from now is going to have a glut. I'm telling you, apartments are going to have a glut a year from now, because this household formation that happened in COVID is a one-time thing. And once that's passed, which already has, you have all these new apartment buildings, a record number that are projected to come on the market this year in 2023. And there's no new tenants. And so that's going to really probably put some pressure on apartment rents towards the end of the year.
Yeah. Rob here has a comment, actually. If they want to know why CPI is high, try looking at the grocery store. So, yeah, although I did see a Vons ad yesterday in my mail, and it was advertising a dozen eggs for $3.99. And I don't know if Chris does the grocery shopping in his house, but I do it at my house, and that's about $2 less per dozen than what you're seeing. So maybe we'll see some moderation in grocery prices coming up. Do you think?
Probably. Eggs was a weird thing, right? Because of the avian flu. So, obviously eggs have moderated, but I'm pretty sure eggs are not a really big part of the CPI basket. Just, I haven't looked it up, but I'm going to guess it's not really a big part of the CPI basket.
I don't know. You use eggs for a lot of stuff.
I know that. I was thinking they're gonna have to edit that part out from Rocky, where he put the 6 eggs into the glass and just drank them raw.
Only 5 eggs now.
Yeah, it was
all
like
I can afford.
Yeah, exactly. You have to knock it down one.
So, geez, I've lost my train of thought here. So Samir says, Chris, if the Fed is likely to raise rates higher for longer to reduce core CPI, what do you expect the 10-year bond yields, higher or lower than current?
So I think over the course of the year, they're going to trend down. So like I mentioned, I think the 10-year bond yield is the opposite of stocks, right? So like I said, let's say that, the economy gets super hot, right? That means the Fed's going to have to really jack rates up high, which means the Fed's really going to have to put us in a recession to cause inflation to stop. If the Fed really has to put us in a recession, then that means that in a not so long period of time, they're going to have to put rates back down to zero to go ahead and get the economy restarted, which means that the 10-year is going to come way down, right? So even though the peak in the short term may be higher than it was before, the faster the Fed jacks up rates and the faster they get us in a recession is the faster they put them down to zero. So if you think about the 10-year span, a bigger portion of the 10-year span is going to be near zero, right? So if the economy does really crappy and I'm wrong and we're already in a recession, and we're not, but if we were, then the Fed's going to have to start cutting rates right away, and the 10-year bond's going to come down, right? So, unless somehow the Fed navigates a perfect landing, right, which they've never done in the history of the Fed, so I'm going to go ahead and bet they're not. I think the 10-year a year from now is probably lower than where it is now. I don't think it'll be any higher for sure, which is why even if I'm wrong, you get 3.7% to sit in a risk-free bond. So that's why I like the long bond.
Okay. James says CPI decrease that came out yesterday did not match expectations, and the jobs report was extremely hot. Does this continue to add fuel to the hawkish Fed stance on rates? I think you said yes already,
Yep.
But I was more interested in the second part. Also, what is the impact of the $31 trillion of national debt? So, Fed's got to pay their bills, right? Unless they don't raise the debt ceiling limit in June, and then we have other problems. Then we'll be back in June with another forecast update, or July.
All right. Yeah. So let me make a couple of quick ones. So first of all, the debt ceiling will be like the debt ceiling always is. Everybody will make it a big crisis, and we're going to default, and blah, 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 blah. We'll add some pork in the last minute. They'll pass a debt ceiling. That happens every time. Nobody ultimately politically, it sucks to be the party. It's going to suck to be the party that really destroys the economy because of a debt ceiling. So that's going to fix itself. I don't worry about that. So the first part, the amount of debt that we have, our debt to GDP ratio is probably like 100%, maybe 105, 110, which is not that high, right? So 31 trillion sounds like a lot, but of course we also have the largest economy in the world. So it's really not that crazy. I mean, Japan's at like over 300% debt to GDP ratio, if you want to think about a comparison, right? So there is a concern about whether or not it can be serviced. There's always a concern that maybe investors won't let us lend any more money, but I think we're pretty far down the road from that. And of course, the federal government can tax you as much as they want. So look forward to that someday. And I think the other part to always note is that there's not one country in the world that has ever successfully paid off their debt. And I can promise you that we will not be the first. So.
No doubt, not in our lifetimes anyway.
That's right.
Any recommendations on how to adjust our retirement investment portfolio? Maybe just cash all stocks and wait for better days to re-enter the market? I think you already answered that, but.
Okay, so let me make a couple of quick ones. So number one, I try not to give out specific investment advice because it's really hard, right? So, when I say that I think stocks aren't going anywhere and I like bonds, just that's something for you to think about. Maybe you want to, again, within your own risk tolerance, if it makes sense, maybe that's something you want to think about, right? If you trade your own account. I think otherwise it's really hard to time the market, right? So, maybe stocks go up 30% this year, and I could be wrong. Okay, I'm a board member that was super bullish about stocks, and I wasn't. So I could always be wrong, and I have been before, and I will be again. And so I wouldn't completely shun the stock market. But if you're retired, and you really need that money to live, I mean, you have to put it in a pretty conservative portfolio, right? You got to be a lot of short-term debt. You got to be a lot of cash. If you don't really need the money and it's there, you have a pension or Social Security, and basically it's going to be someone's inheritance, and that person's 10 years old, then you can roll the dice with it because you should be investing like you're a 10-year-old, right? And you put all your money in stocks, knowing that 30 years from now, stocks will give you a higher return than bonds, right? So it's hard for me to say, but I mean, I'll just give you the conservative approach. If you're a retiree that needs income and needs that money to sustain their life, then you have to keep something pretty conservative, and really long interest rate, really long bonds and stocks are not the way to do that. Really long bonds last year were down as much as stocks were down. The NASDAQ and the TLT, which is the 20-year treasury bond, were down like 25% each last year. And if you rely on your portfolio for income, you don't want to have either one of those investments in your portfolio. So I'll just put that nice to know moment, Susie Orman moment out there in the presentation.
Okay, we got like 38 questions here. But,
one more, but one more.
One or two more. Here's one. What do you think about I bonds?
I bonds are awesome. So the funny part is, back in 2001, I wanted some airline miles, and back in 2001, you could actually buy I bonds with your credit card. So I bought a ton of I bonds on my credit card, my Delta card, and I get a 3.5% real rate of return plus inflation on those. So last year, those babies were making like 13 or 14%. And of course, that's the best investment I've ever made because I wanted to go to Hawaii.
Did you get to go?
Of course, yeah, I got to go, and I still have the I bonds, and they still have another 10 years before they start burning interest, which I'm going to enjoy every year along the way. Yeah. I actually had an article I posted on LinkedIn. So if you go to my LinkedIn, there's actually an article I posted telling you how great I bonds were back in 2019. So I'm glad that 4 years later or 3 years later, everyone has finally caught up to the beauty of the I bond, which is all these negative real interest rates you get on treasury bonds, you eliminate by buying an I bond that at minimum have 0%. And even now, I think they're like giving you some real rate of return on I bonds if you buy them now. So I'm a big fan of I bonds. You can buy 10 grand per social security number. So if you're married, you can buy 20 grand. You can also buy 10 grand for each one of your kids, right? So, you can go out and buy as many I bonds. Treasurydirect.gov is the place that you go for that. And of course, getting back to the $31 trillion number, Steve, the US government is happy to take your money.
Oh, sure they are. Death and taxes, only two things that are certain.
There you go.
So you mentioned it just now about your LinkedIn. I would recommend that anybody who wants to stay up to date on what's happening in the economy, sign up for Chris's LinkedIn account. You post regularly, I think, and I always find it pretty regularly.
Yeah.
more regularly than I do. So, but it's always pretty interesting, your thoughts and even the comments to your thoughts, because there's a lot of, I think, very intelligent people that have, their own thoughts on your thoughts.
Yeah, there you go.
Yeah. So, and the last question to answer is, yes, we will be having another in-person economic forecast in October. So you got a little time to wait, but please keep an eye out for it. You'll certainly get an invite by email. And thank you again, Chris, for giving your time here, the hour today, and all the hours of preparation to present this topic, the forecast update. Also, again, want to thank the dozen or so chambers of commerce that co-sponsored this webinar. We appreciate your support, and hopefully your members enjoyed it as much as I did today. I don't know if we're going to do another one, another Zoom between now and October, probably, depending on how things shake out, but certainly stay tuned to that. And if you want to get see a copy of this, I'll reiterate, go to www.newportbeach.com, and you'll be able to see the video up there probably within a day or two. So any parting words, Chris?
Just, really, I like I said, I'm a little bit more bullish on things, and I hope I'm wrong on the markets. And Steve, it's always a pleasure to put these on. Maybe May, or maybe we'll do another one or June, and then we'll be a good lead-in for the in-person event in October, which hopefully we'll see you guys at.
Sounds good to me. Be well, and we'll see you soon. Take care.
All right. Thank you.
Bye-bye.